Sure. In 1984, I entered the brokerage business. By 1992, I was managing a mutual fund that Jim Turk was special advisor to. Managed 4 hedge funds. In the late 90s, I decided to leave the brokerage money management business and concentrated in a consultant business, mostly in the metals area, and specialized in mining and in particular junior resource companies. And since that time, that's what I specialized in. And then separately, I run another business in the States where I help professional athletes in their financial matters. Well, despite what many seem to think has been an historic and obviously great run, the conditions in the world probably warrant it more now than it did 10 years ago when it was a lot less expensive. As everybody can see through all the news, debt is a huge problem. Currencies are not attractive. But more importantly, the supply and demand scenario has changed dramatically in favorable of both metals. In particular in gold, 10 or 15 years ago, the producers used to cut their nose to spite their face because they would sell so much forward, they would limit the opportunity for it to rise. Central banks were net sellers, and that's all changed at a time when investment demand, particularly out of the areas of the world where money is being made, Asia, continues to rise. So I've called it the mother of all bull markets, and I see no end to it. I don't think people realize what has been set up, particularly in China, and why I believe the demand is going to remain constant. In the U.S., we have what's called a 401k savings plan. It's almost a forced saving plan. Although it's volunteer, most people do it. Money's taken out of their earnings, placed into investments, and it's managed for them. In China, it's the same, except that they do it directly by buying physical bullion. They're not buying stocks or bonds with that capital. The other demand is simply this, is people realize that we don't want to call it peak gold, as there was peak oil, but production has basically stayed flat over these years. It's becoming increasingly difficult for major mining companies to find large quantities, large deposits, yet demand keeps increasing. So again, we got to go back to the supply and demand scenario. And one other thing to point out before I forget, when I first entered the business, the Dow used to trade between 700 and 1,000 for almost 30 years, and when people talked about 3,000 or 4,000, it sounded crazy. Well, 3,000 or 4,000 sounded crazy on gold just a few years ago, but it's kind of realistic right now. Well, interesting, when I re-entered the gold bull market on the positive side in March of 2003, it was just a little over 300, and I talked about a 2,000 target, which seemed kind of crazy at the time. In recent days, I've had to start to consider that maybe it has to be raised. I don't think I need to yet, but I do think that more of the more bullish forecasters, people who were talking about 3,000 or 5,000, who I was not in that camp 6 or 9 months ago. I think we have to start looking back because of what's happening in the world events and start to think maybe I have to raise my target. Absolutely, that's part of it. And if somebody posed the question to me, what's the one thing that can go wrong with your scenario? Overwhelmingly, it would be that for whatever reason, China and India demand would drop. That would be the change. I would be more concerned about that than central bank selling of gold. When I talk to people, mostly in North America is where my focus is. For people with very small amount of money, ETFs appear to be a useful product. I think once anybody's into any size, and also concerns of availability, ability to be even to pay for things, then physical bullion is demandful. I do suggest that as much as I know there was a great talk here by Eric Sprott about silver, I still think at the end of the day when it comes to money, gold is king, silver is second. First of all, I believe a bubble is when everybody seemingly wants it. And like you said, most of the articles are about calling it a top, not a great time to be in. Second, many of those bubble callers have been calling a bubble for hundreds of dollars lower. So I believe it's kind of like the little lone wolf that, you can't keep crying, that all these things are going to happen. But, in North America, perhaps one of the biggest things you see advertised is people that are willing to buy your gold. Well, my opinion is when the public is willing to buy the gold, not those experts who realize that they can get it from the public. I don't think we're anything close to a bubble. And part of framework that I see eventually to the top of this market is when all the bubble callers become bullish. And before that, I think we're okay. I think one man's fair value is another one's overvalue. That's what markets are all about. In terms of GATA's argument, I think, as I said in my talk yesterday, that right, wrong, or indifferent, I deal with athletes. At the end of the day, the only thing that matters is winning. No one remembers who came second in the World Cup or the Super Bowl. The bottom line is their argument and the reasons believing gold was going to go higher is right. I do think that it would be fair to say, and I think this would be a balanced response, is that gold's fair value would be an equivalent to its old high inflation adjusted, and we know that is around 2,500 right now. So I would say, as we speak today, if it was at that price versus the 1650 as we speak, then that would be more of a fair value. That's why I still believe, obviously, it's undervalued. I think the bubble of all bubbles is US Treasuries, and if you think about it, people are flocking into the very thing people were concerned about, whether or not they're going to have the ability to pay. In fact, we just heard of a downgrading of U.S. Treasuries, and yet, they're at record lows. I understand people with an enormous amount of liquidity find sanctuary there, at least temporary, but if there's anything that's a bubble in the last 20 years, more than even the real estate or the internet bubble, it's bonds, in particular Treasury bonds, 10-year bonds at 2.5%. We know if you're living that inflation's more than 2.5%. So I think that's the biggest bubble of all time. I think the problem has been is that most of the money that was supposed to be created in QE1 and QE2 in the United States went into Wall Street and not Main Street. And there's a lot of cash floating around in the big financial institutions, and that's tendency where they park it. I don't think there's going to be much of adjustment. I do think one of the things that people have to realize to this whole argument in Europe and around the world, nowhere in history has it ever been shown that a debt crisis has been solved by issuing more debt. And that's the fundamental problem that continues to be wrong and in a sense aids greatly gold and silver. Well, one of the things I think we're seeing here is we're seeing somewhat of an acceleration now. Perhaps in these last couple of months we've had more of an uprise in that time frame than we've had in gold in several years. Part of that is, I think, is that there's a realization now that the world has decided that they're going to monetize their way out of it. I think this announcement while we were here at the conference that the European Bank is going to go in and actually purchase other countries' debt is a monetizing. It's effectively QE1 for Europe. And I think that's going to actually help accelerate gold. And so any correction that might have occurred, that might have taken longer, I think is going to be a lot shorter now. And it would not surprise me, although I wouldn't say it's going to happen, but I wouldn't be surprised if it did, that we could see 2,000 even before the end of the year, depending on how the markets react now to all the news that we just spoke about. I think if I fell short in anything in these last few years in my business, and that was the overemphasis of believing that mining shares were really attractive. They, as you stated, have not underperformed, they horribly underperformed. If someone would have said back to me when gold was 400, 600, even 800 and told me gold was 1650, the shares that I had in mind back then, I would have substantially believed that they would have more than doubled because the leverage was supposed to be there and they haven't. Of course, the question then is what people ask is why haven't they? Well, I think part of the misjudgments that those of us that were bullish on the shares didn't realize is that unlike 20 years ago when major financial institutions really only had a choice of physical purchase of bullion, which was more difficult at that time, or mining shares, they now have a wealth of other choices, particularly these ETFs. And as much as the ETFs might have helped the bullion price rise, they've hurt those who normally would have went into mining shares. The other problem, I think, is costs for miners. They've gone up dramatically, and we didn't account, we took into account the rise of the gold price, but we never took into account how much higher costs and less profit margins mining companies would have. And I think if there was a mistaken judgment for those of us that were very bullish on mining shares, that would be it. You know, it's interesting. We talked before the interview about when I started, and you know, it's almost 30 years ago. And almost 30 years ago, you would count on one hand the countries that you wouldn't go into because there was political, environmental, or social, or even economical fiascos that you wanted to avoid. Now you can basically count on your hand the countries or areas of the world where you can put your head on your pillow at night and sleep comfortably. All the rest have concerns. So where companies are mining and exploring has probably become as much of an important factor as who's running it, whereupon 20, 30 years ago, that was not the case. I think if someone asks what's the biggest change in the mining and exploration game, it's where companies are located and where they're trying to operate in that has changed dramatically, for the worse, not the better. I think taxing is what government's main weapons are going to be, you know, in these crises, and they'll look everywhere, and I don't think mining and exploration will escape that. I think the concern in the back of our minds for those of us that are deeply involved day to day in this is fears of nationalization or quasi-nationalizations, where the cost becomes so prohibitive and the countries want so much of an interest that it's not worth taking the risk to explore or develop there. I think that would be one of the concerns we have to have in our back of the mind for those that concentrate in this industry. You know, I fully agree with Jim. You know, that has been the argument for those that remain bullish, that gold is money. But in terms of commodities, while we stay in the metals, I think copper, you know, although likely to take a little bit of a breather here because of the slowdown in the world, I think some of the more strategic ones, particularly cobalt, is not a metal a lot of people are involved with, but I think is an important metal. But anybody that thinks the energy crisis is solved by softness in the world is mistaken. Whether it's $80 or $120, anything in that range is expensive. I do think the one commodity, so to speak, that I think has seen its worst days behind and is probably the safest, it may not go up the most percentage-wise, but there's, in my opinion, limited chance of losing, that's natural gas. I think there's a turnaround in that market worldwide, and over the next few years, while it may not leap up, I think it can work its way higher. You know, they are really the precious metals. You know, they're certainly more precious than silver, even though, you know, silver gets put in there. The difficulty is, and why a lot of people don't focus, you know, they're only found in a few areas of the world, in particular South Africa. It's not a very liquid market. There's very limited way for speculators to play it. There's very few mining companies in that area, and that's why they're not often spoken about. We know that their primary use is in converters for cars. It appears, you know, that is going to remain constant, and we know that in some areas of the world, platinum jewelry has become popular, particularly in Asia. So I think they will stay a market performer, but I don't think there's any reason to overweight one in that area versus gold and silver.